Good morning, guys. Hope all is well. Happy NVIDIA Day if you're celebrating it today. It's the 22nd of February, Thursday. NVIDIA announced earnings yesterday, and SMCI is up 32%. That's just ridiculously good. But, as long as you can make the money, make the money. So, NVIDIA announced earnings yesterday, very strong earnings, and that sent the stock up about another 15% so out of my current discussions. That's a good sign. And overall, the market is just up because of NVIDIA's earnings. One of the companies that has showed up on the radar screen consistently is Affirm. And I wanted to talk a little bit about the company because I trade this company. I don't hold it for the long term. Affirm is still not a hold for me. I'm not convinced 100% that fintech overall is in the right spot for me to be able to take a long-term play. There are lots of good opportunities in the stock. When it came out public, Affirm in 2021. I did trade it at that point of time as well, but never really gotten into holding it for the long term. Affirm is in a space within fintech called Buy Now, Pay Later, BNPL. And the leader in the space is a Swedish company called Klarna, Klarna. Affirm competes with Klarna. PayPal has an offering. In fact, BNPL, Buy Now, Pay Later, got so interesting as a concept that even Apple started offering buy now, pay later within their Apple products in using the Apple wallet. So a lot of companies offer buy now, pay later. Think of Affirm as a company that provides short-term loans. That's it. So when they provide short-term loans to a person, previously, people, if they want to buy some things, they might, for example, expensive products, they might say, okay, I don't have all the money. Let's say it's $5,000. I don't have all the money. Can I pay it in installments? Three installments, four installments, five installments, 10 installments. Most of that time, when they pay in installments, what that usually means is that they tend to pay an interest rate on that installment. So instead of paying $5,000 for the product, they might end up paying $5,500, 10% interest, or $5,200, $250, whatever it is, they might end up paying. But a lot of companies have this concept of layover, including Walmart. You can buy the product now, you can pay a little bit down, and then when you have more money, you can buy it. But the flip of that is you actually take the product right now, you own the product, you pay, let's say, quarter of the payment right now and quarter of the payment over the next three times, gives you four payments, and you still own right now. It's good for the merchant because they get the money right away. They get a person who buys the product that previously might not have because they couldn't afford it. It's good for the consumer because they get to be able to take the product right away. And because of the experience, the consumer in a lot of cases might pay for that service, sometimes a small interest rate, or in many cases, the merchant might pay to be able to have the product sold to the consumer without having to be able to offer that kind of credit. And that's what Klarna, Affirm, and a lot of other companies do. So let's take a look at Affirm, see what they do. The company has been around for quite a bit of time. Very interesting founding. The founder, Max Levchin, actually was one of the founders of PayPal. He has worked very closely with Elon Musk and Peter Thiel. Excellent pedigree, one of the best known founders in the San Francisco Bay Area, has really navigated the company through the downturn of COVID because they had a COVID boom, really, really rocketed during that space, during that time. And after that, took a big beating. So we're going to go through that when we go through the stock. But Affirm, at a very simple level, is a lending company. They will loan you money. And when they loan you money, the merchant sometimes might underwrite some portion of that loan, either in terms of interest or the consumer might pay an interest rate. Affirm then takes that. Now, the big advantage for Affirm versus credit, it's very similar to a credit card company, but the credit card company you have to pay within 30 days, and they do a credit check before they give you the credit. Affirm goes around that by not doing a credit check on you. They actually have a direct relationship with you. So you could go, as part of Affirm, you could go to a Walmart, you could go to any other store that accepts Affirm and say, I'm going to buy this through Affirm. Now you suddenly owe Affirm the money, $100 or whatever it is that you own them. And then you can pay that over four installments and you can take the product right away. The merchant immediately gets the money. Now, when they have that $100 on their balance sheet now as a loan that they've given to you, Affirm splits that into three parts. The best of the best people who have high credit, they would keep for themselves because they know that they will get it very well without a problem. The second tier credit, they might actually have a warehouse facility where they give it to somebody else. And the third one, they just sell that loan off because the very small chances are if that's a subprime loan, that might default. People might default on that. So there are pros and cons to BNPL. We'll go through all of that as well. What Firm has done is very, very good in two different areas. They have about 250 to 270,000 merchants. These merchants are the ones that accept Affirm as a type of payment, very similar to they might accept PayPal as a type of payment, or Visa, or MasterCard, or a debit card, or cash. A lot of these, all of these are payment types, payment options. Affirm as an option now essentially is a logo that will be placed. That means if you go to a store that accepts Affirm, you can essentially buy the product right now, whatever the cost of the product, and pay the product off in installments, however number of installments that you can afford, along with what Affirm and the merchant decide. So they've got 270,000, 250,000 merchants on one side. And on the other side, they have little less than 17 million active consumers. They define active consumer as someone that has actually currently either taken a loan from Affirm or has a active payment going on with the firm. So what do you need to do at this? Number first thing you have to do is to be able to understand the consumer and need to be able to understand that risk. So they will collect some information from you to decide whether you're worth the risk of giving a loan. So they have the expertise on the underwriting side. That process is called underwriting. It's taking into account the risk factors associated with not getting paid versus the benefit of being able to make that money from the merchant for 3 to 5% that they might get from the merchant for that. They are a technology company as well because of the payments option. They allow you to be able to go ahead and take a lot of different data points about the individual and the merchant and decide whether the credit is worth giving. They've built this over a lot of years, over these, many. 2005, I think, is when they started. 2008 is when they started, and they started growing. Or after that, actually, 2000, much later than that. I don't remember right now, but we'll go through that as well. They have then gone and built a lot of partnerships with other people, such as Shopify and other merchants, online merchants as well, to be able to accept Affirm as a payment option. So the next revolution, besides providing the ability to be able to go ahead and make loans for you, Affirm is essentially provide you with a card. And that card, essentially, think of it like a credit card that is underwritten by Affirm, or you can use it as a debit card by putting money into Affirm and then drawing it down. A lot of people, young consumers especially, like Affirm because unlike a credit card, they don't have to, in most cases, have a balance that they have to pay interest rates, heavy amount of interest rates with. And I think this is just a budgeting facility more than anything else. They know that they buy this particular product for $1,000 at firm, they have to pay it off in 3 payments and they're done. What happens with credit cards and the bad rap that they get is some people are not able to make the minimum payments for 1 month and the interest rate goes up to 26, 27% right now for some credit cards. And that payment just keeps on ballooning over time. With Affirm, you're just buying that specific thing for a specific period of time. You're paying it off in 3 to 4 installments. You know exactly how much you're going to pay. Okay, so the next version is they allow you to be able to do Affirm at checkout. You can pay over time, in many cases with 0% APR because the merchant is underwriting the fee. Or Affirm Marketplace, where you as an individual go to Affirm, you see a lot of deals that are available from partners. If you buy it via Affirm, Nike might give you 20% off. Home Depot might give you 25% off. And then the Affirm card essentially is a request payment plan type. So it's very similar to a credit card or a debit card, but it's a BNPL, buy now, pay later card. Whether you are in a store or you are online, you can essentially use the card and say, it's like a credit facility that's given on to you from Affirm. You have the purchasing capability for up to X amount of money. Let's say that's $250. You can go buy something again and you pay it off in installments. In many cases, 0% interest. So now this becomes a capability for Affirm to be available and be as a payment option in a lot of different places. So why do consumers like Affirm? I kept looking at this, trying to understand why the younger people seem to like Affirm. The big advantage is the control of their money. That's the number one thing. The flexibility that Affirm gives you is essentially to be able to control and say whether I can pay this much interest or not. Credit cards, notoriously a lot of people after 2008 timeframe really hated credit cards because the ballooning payments that they had to pay with the interest rates on those credit cards is literally all over the place. Many of the credit cards entice you with a very attractive initial rate of 0% for 2 years or 1 year. And then after that rate, after that time, it just jumps. So many consumers also do this jumping. They go for 2 years to one card, 0%, they take advantage, then they jump to another card, transfer the balances. The real thing that you want to be able to do is to force yourself to make that payment. So Affirm makes that for you. You have to give 4 installments or 5 installments, whatever it is. And you can split that payment into transaction over multiple times. So if you're not able to afford $1,000 for, let's say, a very high-end digital HD TV, you can make that in 4 payments of $250 because you know every month you're going to get that much of money. It's got a lot of acceptance. So the consumers like it as well because you can literally go practically a lot of 250,000 merchants is not a lot, but still relative to the total number of merchants that are available. But for the kinds of customers that they have, consumers that they have, Affirm is available everywhere. And they are even able to do it for low dollar items as opposed to for longer items, for more expensive items. And the key feature that they also like is that it gives the ability for the consumer to be able to get more new offers and new kinds of options and discounts as they are able to move forward. And that essentially has resulted in literally 17 million, almost 17 million consumers from card. From card is the new product, which is about 500,000 customers, but Affirm overall has 17 million consumers. The monthly GMV just from the card, in terms of the total number of transactions that are on the Affirm card, is now going to nearly about $100 million monthly, right? And then revenue, less the transaction costs, essentially, they are going from a unit economics of being negative. Merchants would pay them some money, but they had to get the initial number of merchants to be happy about it. Now they're actually starting to make money on this. And they're also tapping into new kind of spending cards. Previously, you'd find that Affirm was primarily used for travel and used a lot for consumer electronics. That used to be the initial set. Now, Affirm is being used for everything, most specifically for grocery stores. So think about it. You go to the grocery store, your bill is $50, you can pay it in 4 installments at $12.50 each. That's just a lot more spend management than anything else. And typically, as I mentioned before, online travel agents, number one, used to be the number one thing that I would see a lot of people actually put on Affirm. They go on a vacation for $1,000 paid off in 4 installments. And of course, the usual discount consumable stuff, mostly in the electronic space and also a lot in the home improvement space. When I was at Build Direct, we see a lot of customers wanting us to be able to accept Affirm so they can pay off their flooring upgrade in a 4 or 5 different category. By GMV for them, as I told you again, this was the number one: travel, mobile electronics, as I mentioned, and then home improvement were number three. These were the number three before for buy now, pay later. That has now changed with a phone card, be able to make it more grocery oriented. Okay, how are they growing their user base? What is their strategy? The strategy number one is to be able to get a lot more people coming in to be able to get Affirm through the merchants themselves. You go to a merchant, you go to the mall, you suddenly see Affirm, you download the app, you can pay for it through the app itself. They also give a lot of merchants give a lot of offers because they might want to sell a product. They're willing to give them a 0% interest rate. Then the merchant pays a certain amount of money, 3%, 5% of the transaction fee to Affirm, and they make money that way. As you get more offers, this network starts to improve. So as more consumers come, more merchants are willing to accept. As more merchants are willing to accept, more consumers come. More merchants are willing to give more offers, more consumers are even more interested. So that's what creates the flywheel. It starts with having Affirm being available in a lot of different merchants and consumers really loving the flexibility of being able to pay for it in a simple, easy manner in 4 or 5 different installments. Okay, because of that, they can give offers and perks. Literally, think of it like the new age wallet for you. You can come back in the Affirm app very frequently, and it says, "Hey, we have a new offer for you," even in places like the gas station where they can give you 10 cents per gallon back. So it becomes a loyalty program of sorts for some people as well. Very, very smart strategy by Affirm to go beyond and above where they were before. Now, from money market account, essentially money account or money market account, transactional account, gives you the ability to be able to save money. So if you have your paycheck coming in direct deposit into Affirm, so it becomes literally like a bank with a non-financial, non-banking financial institution. And they're like a neobank in some senses also. They're trying to expand that capability. And that gives you the ability to get a lot better. So they would compete at some point in time with the SoFi. They would compete with the NU Bank out of Brazil. They would compete with some of these guys and Money Lion as well. But right now, buy now, pay later as an installment option is very, very valuable. Think of it this way. SoFi is competing with JP Morgan, Bank of America, Citigroup from the banking side. And Affirm is competing with the card players from the credit card side. That's how you got to think about this. And of course, now that these players can offer both products, eventually they will all compete with one another. Okay, the Affirm card very similar to a credit card in some ways, or similar to a debit card, depending on how you want to take a look at it. Addressable market just within the US is about 240 million users, and they have only a very small penetration, of which the prime, meaning consumers who have a very good credit rating, are usually prime 700 and above, 750 and above. They can really target about 150 million of those. They have a very small number of them. Registered users, they have 40 million, but active users in the Affirm marketplace, they have about 17 million. The marketplace itself is about 7 million. So they have a lot of opportunity to be able to grow. Right now, the total number of users who ever used and registered with the firm is about 40 million, and they can grow up 6 times that. And the active number of users using a phone card is only 500,000. So they started initially at the checkout as a buy now, pay later option. That was back in 2008, 2000, actually 2014, 15. Then from anywhere gives the ability to be able to go online. They now offer the credit card option or a firm card option, money market account, and the ability to be able to have consumers manage their products, especially younger consumers, from an end-to-end perspective. So how do they win at the checkout? So when you go to checkout at a company, you have a lot of options. You can pay by cash, the simplest way to pay for a lot of people still. You can pay by credit card, which is what most of America does, pay by plastic, or a lot of consumers pay by debit card, or they might pay by a PayPal option, or they might use a merchant store card. For example, Sears or Macy's or any of these other companies like Home Depot have the store card. Or you can pay by store credit, which means you are actually paying in a credit card. Macy's has this as well, and then you pay them every month. It's like a store credit. First thing they do is to make sure that Affirm is available as a checkout as an option. So that gives you new merchants, which means more consumers are happy when they get that. Then they want to get as much of the total purchase as possible through the partners. So when they have partners like Shopify, partners like, they want to be able to make sure that a big commerce, they want to get more people to be able to accept an option. And then distribution as well, making sure that more consumers can see it. Now, merchants on the other side, uh, the number one reason why merchants are happy with the firm is because they can make a sale. That's it. There's nothing more to it than that. And they pay a small percentage of the fee, very similar to what they would pay for a credit card, for example. So instead of paying 3% or 2% for a consumer who wants to buy it, and then the merchant pays them 2 to 3%, they pay a firm that 2 to 3%. So the merchant reach itself is about 60% is their integration option. And then leading awareness is about 50% of them actually know about Affirm as an option. And because they don't charge late fees, they're very good with making sure that they don't charge the ridiculous fees that credit cards charge. It becomes a lot more valuable for merchants themselves. Okay, merchants are actually happy because nearly 76% of shoppers have been happy if Affirm is offered as a payment option. So you get an uplift just from the fact that a lot of people say, "Oh, you're using Affirm. You offer Affirm as an option. I'd love to be able to use that." When they do that, they find that their consumers are looking at buying more than they could before because they know exactly how much they are going to be able to pay. That improves conversion, which is what merchants really want. And repeat purchases tend to be nearly 90%. So their core customer base of the total GMV is about 7 trillion. Their e-commerce is about a trillion. They're only about a $20 billion right now in terms of the market opportunity. And within the overall BNPL, which is buy now, pay later options, about 60 billion. PayPal is a very good option as well, but Affirm is a pure play, just focus on buy now, pay later. So in terms of the types of companies and merchants, SMBs or tend to be the big ones for a firm overall. But a lot of the big merchants are also starting to be able to work together with the firm to offer this as an opportunity. So you look at the $900 billion opportunity to a $1 trillion opportunity in terms of market size, the total addressable segment. Within the mega caps, they have 15% coverage, which is a large companies, enterprise companies about 10% coverage. So the overall coverage is very low. They still have only about 3.5 million merchants that they could cover and about 270,000 merchants that actually use them and offer them on an ongoing basis. So beyond the core markets that they offered before, now they're trying to get into work with the Chinese retailers, whether it's Shein or Temu, TikTok Shop, etc. Those are the new people who have a very low average order volume. Transactions are the $100 marketplace, and using the option to be able to go ahead and offer Affirm as an option is a very, very good opportunity for Affirm to get to new customers. Now, expansion opportunities beyond the 7 trillion to go from 1.3 trillion, which is currently, to go to about 10 trillion means that they offer a lot more retail in-store options and a lot of different evolving new places where Affirm can be offered. You can do it in charities. You can do it for professional services such as cutting your hair, nail salon, etc. So they want to be able to expand beyond that. They have partnerships with e-commerce companies. So if you let's say you're a merchant on Shopify, immediately out of the box you have Affirm offered. If you're a payment system provider such as a Stripe, then Affirm is another option that is offered just like credit card. So for Stripe, they don't really care how you buy. They're going to take your 2%, 3%, whatever it is that they take. So Stripe will take a little bit of money, keep a little bit of money, send the rest of the money to the network. Think of Affirm as another one that actually does the same network itself. And then within the wallets and the browsers, whether it is Edge browser or even Shop Pay, allows you to be able to partner with a firm to get money that you can pay for the merchant in that specific way. So sole proprietorship, small companies, that was the initial one. They also offer to lend money to them. That's another option. They haven't done a big job of it yet, but they have an opportunity to be able to go after that market and expand their total addressable market. Okay, so what does a firm does from a B2B perspective? Let's look at it from that way. Not just consumers, but also businesses. Uh, when a B2B purchase usually means, for example, let me give you an example. You're a contractor, you lay flooring. Now, when a customer comes in and says, I want to be able to get this flooring, you need to go as a contractor. Once the customer has picked that flooring that they want, go to Home Depot, buy that, install it. After it's installed, the consumer pays you, right? So that's you are a business. You go to Home Depot, you pay them, and then you install it, and then you get paid by the consumer. So you're in the middle as a B2B. That's their core SMB, sole proprietor marketplace as well. For them, they have very limited financing options. As a contractor, you're not going to be able to, you can put on your credit card. Sometimes in other cases, when you will pay with cash. But this big advantage for sole proprietors is the credit card is not offered for the company. It's you have to put on your own credit card, makes it a mess. Very, very difficult to be able to manage expenses. So you're better off to be able to go ahead and get an Affirm, put it on that Affirm check card, whatever you want to call it, buy now, pay later in 4 installments, go over across to Home Depot, buy the product in your Affirm wallet, install the product, get the money from the consumer, and then pay off Affirm. On the seller side, they don't have a lot of credit options that they can give the small buyers. Small proprietors are notoriously weak in terms of credit line, and then it gives them the ability to be able to sell to them as well. So what does a firm do? They focus, obviously, they're like a technology company like everybody else. They have a strong network of both buyers and sellers. They have data security capabilities on top. They have the technology built to be able to make sure that they can look at the ledger, look at the risk for every single customer, manage the capital effectively, and then P1 to P6 through all of these are different options for the types of accounts and cards that they have. Affirm Capital gives loans. That's the B2B side of the business. 8 years ago or 2 years ago, they had about eight transactions. Now they're doing about 14 transactions, 75% increase in terms of the number of investors. Now, 2 years ago, also, they would sell these credit lines to their investors who wanted to be able to buy it. Warehouse essentially means you're bundling a lot of loans that you've made and you're selling it to a warehouse facility that manages the loan and will then give you the money up front. So they don't have it on their balance sheet. Some of it they'll have on the balance sheet for the prime and the over prime, and the non-prime, they might give it over to that itself. How do they fund their business? So a fund needs a lot of capital. It's very simple. When they make loans to people, they give the money right away. When they get the money back, they get it in 3, 4, 5 installments. First thing they do is warehousing. Essentially, with top-tier banks, they'll say, we'll keep giving you these loans. Give us this credit line of facility so that we can go and make those loans. And as soon as those loans are made, we'll give it back to you. We'll keep our fee and we'll give it to you that way. The cost of funds is fairly high in that particular series, in that particular case. The second one they can do by bond issuances, excuse me. And they do that as well. You'll see on their balance sheet, they have quite a bit of debt. The third one is forward flow, which is essentially sale of the loans. They bundle together all these loans and sell it off to a company without a problem. Efficient, that is one of the most efficient ways because they take their permit, they can start making balloon loans, they can sell it off, somebody else owns the loan now. But obviously, there are pros and cons in every one of these cases. Okay, since the IPO, since fiscal year 2020 and just the IPO in 2021, they've grown phenomenally. 4.6 billion to about 21 billion in gross merchandise value, GMV. Total revenue has gone to about 1.7 billion. Their return, less the transaction fee costs, is also grown very, very well. And their adjusted operating margin has now gotten to the point where at least it's positive. Now, when you look at the penetration of US retail, as we talked about this before, their expansion opportunity is not just within the US, but how can they go outside of the US? Opportunity number one is just grow their core retail side. Opportunity number two is to go to the B2B side on the US market. And opportunity number three is to go international. And very similar to Visa and MasterCard, they're looking at each of these opportunities in individuality and seeing how they can grow from there. So the product mix in terms of financing, interest bearing versus pay in full versus pay now. The pay now option is the smallest, which is using a phone just as you would use as cash. It used to be about 27%. It's gone very much down. The interest bearing is interesting because they're essentially providing a credit card to a customer that doesn't have a credit card. It's operating just like a credit card. So I'm not really necessarily sure why this has been growing dramatically fast for a firm, but I guess there's a certain set of customer who's not getting a credit card prefers to use a firm as a credit card because the interest rate payments may be a little bit more transparent in a firm side versus 27, 28% interest rates in credit cards from most of the other places that offer Visa and MasterCard. So that's their mix, if you will. Now, because of the fact that they've got a lot of partners, they've given a lot of them, for example, Shopify, they've given them warrants. What's a warrant? A warrant essentially is a portion of the company given to that other company in exchange for the partnership. So they'll say, okay, we'll give you 5% of the company, and those are warrants that you can exercise over time, which means you can buy the stock at this price, and the price might be $5 today. But when the stock price go to 45, they could sell it if they want. Because of that, they've given these warrants, and they've slowly gotten better at giving fewer and fewer warrants to times. And Shopify is an example of a company. They do it very often. At the same time, the other big challenge for them is stock-based compensation. The firm is not exactly the most. You look at when you go to the balance sheet, look at it when you go to the fundamentals. The fundamentals are not going to be solid because of these two things. They give a lot of warrants out. They dilute the hell out of this company every frequently, which is why I don't like holding it for the longer term. When the numbers get better, I might change my mind. The second part is their stock-based compensation is very typical of most San Francisco companies and Bay Area companies, ridiculously large. So they've got to make sure that they get that down. And that's one big advantage for them as well as an opportunity. So that's a firm as an overview. Now, let's find out what is it that we can do from our five-step process, see what we like about the company and what we don't like about the company. Um, our five-step process always starts with the fundamentals. So let's go through the financials first, see what we like about the company's income statement, and move from there. I already told you there are quite a few things that are not good about this. So I'm not going to give it more than a 7 out of 10, but still good to see. The good thing is it's gone from 237 million in revenue, 264 million, sorry, 260 million to 1.5, 1.6 billion. Let's make it 1.6 billion in 2023. That's phenomenal growth, right? That's nearly 6 times growth. 6 to 7 times growth. Very, very good growth in 5 years. Very well moved. Decent margins at 70, 80%. Gross margins. Net margins, they've been losing a lot of money. So yeah, I don't like it too much because they're losing literally the same amount of money they're making. They're losing, look at this. They make 1.5 billion, they lose about a billion. I already told you that though. I told you that no, they're not going to get more than a 6 or 7. But the growth has been phenomenal. It used to be very, very good, slowed down dramatically. Look at the growth on an annualized basis. It's grown 100%, 70%, 50%, then just dramatically dropped. So that had dropped and now it's picked up back again. I like this graph. Look at this, 7 and then doubled and then went up from 20 to 30s, got up to 40. So they're picking up back growth again, which is good. Margins are still good, 80, 85% margins on the growth side. Net margins, okay. So the good thing is they're reducing their net losses from 250 million or 300 million down to 200 million to 170 million. So they're not doing it fast enough though. Let's look at the balance sheet. They have $8 billion in current, no, but, so that's the challenge. They're just losing a ton of money, man. And that's being used for a lot of different things. So about $2 billion in current assets, 6 billion is in non-current. I'm not going to count that too much. They've got 6 billion in debt. Yeah, this is I knew that I was not going to like it too much for anything other than a trade. It does come up to a trade and very good opportunities. Technically, this is one of the great stocks to trade. Long term, I'm still not sold on this. So valuation for someone growing at 46% last quarter, if you remember, 17% for the year, but 46% for the last quarter, and hopefully get to the 30% for this year. This is a decent valuation, but their margins, 84% gross margins, losing 30% net margins. So they've got to improve their margins very much. They've got to improve their debt situation. This is on a scale of 1 to 10, I'd still give them a 5 or a 6. But this is the reason why, from a technical standpoint, let's go to now the technical analysis. On the long-term monthly chart, very good consolidation, stage 4 decline, stage 1 consolidation period, stage 2. This is a stage 2. This looks like a beautiful from August 21 to October 21, was it? Yeah, October 21, stage 2 markup, stage 3 consolidation, stage 4 decline, and then it's built a very good base. You could technically think of this just as a consolidation period, but this is a nice base. This is the cup, this is the handle, so it should move up from here. But you will find that there will be some resistance for it right at this spot. I think somewhere in this area, the 53 area, there should be quite a bit of resistance there. It's like to move there twice. On the weekly chart, so you know already that there's going to be quite a bit of resistance in the 53, and there you can see it's gone down a couple of different times on the 53, 50 to 53. Don't get very specific and hung up on specific numbers, but this looks like it might come down to about 34. And then this is the cup, this is the handle, and if it confirms for me that it starts to move up, this goes easily from the 35 zone to 53 as an up again. They have earnings coming up fairly soon, so I would be very interested in knowing where they are doing from that earnings. So on the weekly chart, very good move. Nice consolidation. Cup. This is the handle, and they should touch the 35 zone and then move up. On the daily chart, let's go to the daily chart now. On the daily chart, this hit the 52-week highs, the 53 range, and then since then has been moving down. So this is not exactly a head and shoulders, but this could be the left head. Yeah, you could call it. This could be the head, left shoulder, right shoulder. You could call it, but you're really stretching it if you do that. So it's gone down quite a bit. It's still on the downward movement in stage 4 decline, I would say, in the daily chart. It should technically have found support. It could find support even at the 32 range, but it's gone below the 100-day moving average. So I'm not sure it's going to really bounce. It might retest this level, or it might go a little bit lower, but this is a good level to watch. The 35, 36 is a good level to watch as well. It's bounced off of this kind of a dollar really in the last day or so. Does it going to bounce and it's going to keep moving in this new direction, or and then face another resistance, definitely in the 43 zone, maybe touch that back again. But if it does that in a good way, then it's a chance for the company to be able to make it move up. Though again, it's a trading stock. I'm not going to be convinced that you're going to let me hold this for a longer term. It's a very good stock to trade, gives you reliable moves up. This is going to be a very reliable stock to be able to trade even right now. As far as I can see, I'm going to watch for the 36 reversal. If it does a 36 reversal, it's a very good opportunity for it to get back all the way to 43. Then it might test the top end of this channel, may move down. Worst case, it goes up to about 49, moves down again, retest the channel, and then moves up back again. On the moving averages, 100-day moving average has been breached. It gives you a couple of opportunities to get the 200, so it could get to 24. I really doubt it. Earnings just came out a couple of weeks ago. They beat earnings both on the top line and the bottom line. It looks like they did that very well. So if they did that, what was the reaction after earnings? Very strong green candle and then moving down. Okay, strong. The volume was good, but now the volume seems to have gone down quite a bit. So the sale is moving down, but not on very high volume. So this was the very nice move post earnings up. And then since then, it's just been on, not been able to catch a break. RSI, not good yet. I wanted to be able to pointing up and above this zone. So you'd want to wait for this clearance. Wait for the clearance to see if it is confirmed above the 100-day moving average, which is 40. If it does, then it's likely that it's going to get at least to 45, which is a 10% move, which is a good move. Otherwise, it might just bounce off of this and go down back again. The MACD is not currently ready. I don't think this is ready for a trade yet, for me at least. You could take a trade, but this is not, in my mind, set up very, very well. I'm not saying it won't go up, but it's not a good setup. There's more risk than there's reward, and there's too many signals on the yellow. Thank you for watching. Let me know what you think.